Welcome to the FarrCast, bringing you insights into Wall Street, Washington, and the world. And now here's your host, Michael Farr.
Welcome to the FarrCast. I am Michael Farr. Thanks so much for joining us again this week. It is September the 12th. Wow, what a debate. What a debate. What a debate. Most folks who watched the big debate said that Vice President Harris won, more by keeping her cool than showing any great originality. She did, to most viewers, and I read several articles afterwards from all different types of media, suggested that she appeared presidential and that she got former President Trump's goat. That she provoked him, got his goat, and that was basically the sum there. We'll see. It moved the needle. I think the most important thing, ladies and gentlemen, we'll ask Dan Mahaffee in a bit. The most important thing that happened on that night was the Taylor Swift endorsement at the end of the debate. Taylor Swift has hundreds of millions of Twitter followers. She had over 10 million likes in a few hours, and she signed a single cat lady. That was her signature. Thank you, J.D. Vance, Senator Vance. They teed that one up. So, as usual, and I've mentioned this before, years ago when I asked James Carville whether Biden would beat Trump, and he looked at me and he said, remember, two things. You got this? I'm only tell you once. Two things. Here it is. Joe Biden can't beat Donald Trump. That's it. Joe Biden can't beat Donald Trump. Number one. Number two, Donald Trump can beat Donald Trump all day long. And I give you about 50-50 odds, son. I think we're seeing, ladies and gentlemen, the wisdom of James Carville. Once again, no matter which side of the aisle you're on, the guy's been a pretty darn good strategist. Therefore, I think President Trump can beat President Trump. There's still a lot of time before this election for President Trump to get it back on the rails. It's an uphill climb at this point, but I think the Taylor Swift thing was big. I watched J.D. Vance this morning on CNBC. He acquitted himself, I thought, pretty well, and he followed the Trump script and Trump playbook. So we'll see what happens. And of course, this means not a great deal at all to markets, because markets have continued to rally. We did have a bit of a dip and a bit of a pullback, and perhaps it's the one that we should have bought. We're going to find out about that. But S&P still near all-time highs. It's just a shade under 5,600 on the S&P. NASDAQ, same, 17,570, and the Dow Jones Industrial Average over 41,000. These are not markets that are having problems. The 10-year Treasury is 368. The yield curve has returned to normal. Will we have a recession? Will we have a soft landing? If you listen to Warren Buffett, he says, over a whole lot of years, corporate America continues to grow and expand. And that's what you have to pay attention to, folks. So the Fed meeting next week is still going to be the next big thing to watch. What they say, how they say it, looks like a quarter of a point to me. What do we do when we need to find out really what's going on? We talked to our friend Kenny Polcari, one of the best and brightest minds on Wall Street, the voice of the New York Stock Exchange for many years, and chief market strategist for Slate Stone Wealth. Kenny, welcome back, pal.
It's always a pleasure to be back, Mike. How are you?
I'm wonderful. I'm doing just great. The weather has finally just gotten beautiful here on the East Coast. 75, 80 degrees during the day, 60 degrees at night. Oh, it's glorious. Absolutely glorious. So life's good, Kenny. Life's good. What do you think's going on in markets? You and I have said before that politics don't matter as much, other than short-term stuff. They don't matter much in the long term. What are you thinking now? And I'd love your impression of the debate the other night, too.
Okay, great. So I think there's a number of things going on. I think that we're in that seasonally weak time of year, which in and of itself is always a concern around this time of the year. So that's the first thing. We're concerned about where the Fed is going next week. I think the market is now convinced we're getting a 25 basis point cut next week. but they're still trying to push, and they're still talking about a 50 basis point cut either in November or December, which I think, again, is erroneous. I think we're getting 325 cuts, and that's it. And by the way, I think that's what we should get. I don't think they should front-end load it or try to make a 50 basis point cut at any one of the meetings. And then I also think there's the nervousness around, or the angst, not so much nervousness, the angst around the presidential election, which is now less than 6 weeks away, and early voting actually starts next week. And so I think there's some anxiety over that, especially after kind of what we saw on Wednesday night. I don't think any of it, I don't think any of them answered relevant questions as far as I was concerned in terms of specifics about taxes or the economy or national security or inflation. I think they
Correct.
just, I don't think that either one of the moderators honestly came up with the right questions or asked the right questions, because they didn't ask those questions. I think they all fact-checked every single thing Donald Trump said, but they never fact-checked anything that Kamala Harris said, which I found frustrating. I just said if they're going to fact-check one, they should fact-check both. He clearly made comments that don't jive with her prior comments, but nobody called her out on it. So a little bit frustrating. And I heard, I agree with you that the next day the Main Street media gave her the win, and that, but I think the bar for her was low to begin with. I think people didn't expect a whole lot, so therefore it was an easy bar for her to jump over. And I do think she did. I don't think she let him get under her skin as much as maybe she got under his. I think he went off the rails a couple of times. I think he went off the rails a couple of times in some of the stuff he said or the took it. But in the end, I think yesterday's nervousness was a little bit of the fact that, well, if she gets in, how bad is it really going to be? And is it going to be taxes on unrealized gains? Is it going to be, raising taxes across the board? Or can we hope for a split Congress, which would really kind of neutralize her? Because with a split Congress, that's the best. Actually, the market prefers a gridlock, a split Congress, because then it keeps the fringes on both sides from really taking control, and it becomes much more moderate, which I think where the majority of the country is.
Yeah, I think that's certainly the most of the country is more moderate. And I think it did feel like, I'll ask Mahaffee about this, but to me, watching the debate, it felt like the moderators had maybe their thumb on the scales as they were following up with certain questions about to former President Trump. But it didn't. It felt that way. I don't know. Some of his statements can be a bit more bombastic, which would perhaps provoke them to kind of address things like the dogs and cats things. Maybe we need to address that one in real time. But, in general, I still felt like they had a bias. We'll see where it all goes. But, if you just look at the policies, if you look at the proposals, if you look at this notion of taxing unrealized capital gains, that is as moronic a proposal as I can possibly think about. I mean, there's no practical application way to do it. You've got small business owners who are building value in their businesses.
Right.
I don't mean multi-million-dollar businesses. I mean even bodegas. I mean small businesses that might be worth $1 million or $2 that people are scraping by to get together and putting payroll on their credit cards at different points. Some of those businesses have values. You're going to tax the unrealized capital gains as they're trying to build the business. It doesn't make any sense. You simply can't do it. So if you're waiting for somebody to come up with a proposal, I'm still waiting too. I'd love to hear a decent economic proposal. And both of them are for deficit spending and continue to increase the national debt, which is truly moronic. You've got to stop this. Huh?
That's really the first thing you do have to stop that out of control spending. And both sides, to your point, it's not just a Democratic thing, it's both sides, right? So you have to somehow pull that in. The question is, are they ever really going to pull it in? The fear is that they're not. And that once they get in there, they don't have to, or they feel like they don't have to. I think, I certainly don't support that at all. But you and I are not sitting in the conference room with them in the cabinet. So
You
I
don't
guess
you
we have
don't
to sit.
support you don't support this ongoing spending, and neither do I. That's what you're saying, right?
Correct. I do not support the ongoing spending from either side. Correct.
Right. This ongoing deficit spending and fiscal irresponsibility and waiting for some sort of bang moment. Oh, it's fine. Oh, it's fine. Oh, it's fine. And then all of a sudden, holy crap, it's not fine.
Right.
And we've got
Right.
interest rates that are going through the roof because nobody wants to buy our debt, and you got issues. Oh, Farr, you're being one of those old inflammatory guys. You guys just like saying stuff like that to scare people. No, I don't. And remember that
Right.
I said it, and remember that Polcari said it, and remember we said nobody was listening. There you go.
Right. To your point, the larger that deficit gets, the more Janet Yellen's going to have to come with her tail between her legs to the public market to try to sell treasuries to fund the debt. And the more supply she brings to the market, the lower the bids go. And when the bids go lower, the yields go higher. Period. The end.
Yeah. Yeah. I mean, it's listen, if you have 10,000 cars to sell, you're going to get this price. If you have 1,000,000 cars to sell, you're going to get a much lower price per car, a much lower price. Okay. Kenny, markets are doing fine. The earnings season was okay. Interest rates are coming down. The yield curve is once again positive. We're going through this difficult period of the year. Tell me where you think we end 2024. What are your expectations for 2025? First year of a presidential cycle is always a bit tough. And what do we tell Fred and Ethel in here?
So here's what I think. I think we've got 4 or 5 more weeks of ongoing volatility just because of the seasonal time that we're in. I think you and I both can agree on that. Then I think that the market, bottoms out in October, and then it starts to make its way as we move into the end of the year. At the end of the year, I think we probably end up right about where we are today. In the mid 5,500 range, I think is where the market will end up at the end of December after it pulls back. I wouldn't be surprised to see us test the August hit low of 51.16 again on the S&P just to see if there are really any bids there. I think that actually has to happen because the way it happened in August, it happened so swiftly and so quickly that the market continues to need to have to repair itself. And the only way it's going to repair itself is by testing that level again to see if it really holds. That's number one. Then I think it rallies into the end of the year. Then I think we get through this election. Now, if the election is, like I said, whether it's a Democratic president in a split Congress or a Republican president in a split Congress, either one of those would be the best outcome for the markets because, again, it would provide gridlock, right? And the market prefers gridlock over one party having complete control. So we'll have to see where that goes. In 2025, S&P earnings are expected to jump by 14%. Those numbers haven't come down yet. This year, I think we're going to earn $243 a share in the S&P. Next year, it's supposed to be $278. Now, I suspect after we get through the election and we kind of see where Jay Powell's going, those numbers certainly will be adjusted. But I do continue to think that next year will be another strong year for the economy, for earnings. And therefore, I suspect that the market will be okay, right? As long as Fred and Ethel, as you and I discuss all the time, has a quality, well-diversified, broadly diversified portfolio with the biggest names in each of the industries that they're exposed to, right? So you want the big names. And some of them are boring names. You want utilities. Look at utilities. The most boring sector in the whole world is outperforming everything this year. I think it's up 23%. It's the sector itself, right? And there's a lot going on in that sector. AI is changing that sector. And so there's a lot of excitement there. But I think you have to have that kind of exposure as you go through the end of this year into next.
Listen, one thing that does have me concerned, Kenny, you're looking for 243 next year. You're looking for a 14% pop in S&P 500 earnings at a time when almost every company that's been reporting, particularly those that are facing the consumer, have been saying we are seeing weaker spending out of our consumer. We're 70%, 67, 68% economy driven by the consumer. The consumer right now is showing signs of weakness. Credit card balances are going up. Delinquencies are going up. So I think we've got a little bit of a credit squeeze. We're coming at the beginning of a consumer squeeze. I think this holiday season and what they are able to do through the holiday season is going to be important. I don't see 14% for earnings growth next year. I'd be delighted to see 10, but that's maybe I'm
So
being just a fuddy-duddy, but
no, so
I'd take 10%
no,
all year.
right. But my point is, I agree with you. The current expectation is for that to be. That's what the current forecast is for 2025, showing a 14% increase. I also don't think it's going to get there, but I don't think it's going to be a disaster. To your point, we're going to see numbers start to come down. In fact, you already saw it the other day with Jamie Dimon, right? That yesterday, 2 days ago, when JP Morgan, took it on the chin, because he came out to say, right ahead of earnings, which start just in 3 weeks, he came out to say that he thought the analyst expectations were a little bit too high on the net interest income because rates are going lower. And if rates go lower, then that number needs to be adjusted. He didn't say anything that's untoward or that was a secret. Any analyst would realize if rates are coming down, well, then you have to look at that number because that number will change. That's part of the equation. And so what I think you're going to start to see is other CEOs come out when they're a little bit concerned, or maybe they think that the numbers are too lofty, that they are going to guide lower. So I think that number next year will guide lower, but I don't think it's going to be a disaster. If if it goes from 14% to 9 or 10%, I think that's about where it'll be.
Kenny Polcari is CEO of Case Capital Advisors. He is the chief market strategist for Slate Stone Wealth and my great friend. Kenny, thank you so much for being with us.
Always a pleasure. Thanks for having me.
Ladies and gentlemen, we're coming back with Dan Mahaffee as we understand all things political. God help him. God help me. God help all of us when we come back on the FarrCast.
Thank you for joining us this week on the FarrCast. Now it's time for political analyst Dan Mahaffee and your host, Michael Farr.
Welcome back to the FarrCast. Dan Mahaffee is the vice chairman of the Dr. Scholl Foundation, a fellow for the Center of the Study of the Presidency and Congress, a Washington, D.C. think tank, and the senior political analyst on the FarrCast. Welcome back, Dan.
Thank you, Michael. Good afternoon.
Good afternoon. Well, we had the debate. We had the must-watch TV. It was everything I had anticipated. I can't picture what word that got repeated most often that would have really gotten me drunk had we been playing one of those big drinking games. I was thinking fake news, but that really didn't come up as much. What did you make of the debates, and has it changed the landscape for this election?
Look, I don't know if we would quite say it's changed the landscape, but it was a clear contrast. And I think each candidate is ruining some missed opportunities, although I think for the former president, it was definitely a harder night when it just came down to trying to show a difference in temperament and in some way a difference in generation. And that's where I think Harris has continued remarkably, even as the sitting vice president, to be able to continue to position herself as the change candidate. I think that's the biggest factor we've seen her continue to be able to do. And on a night when I think, unfortunately for the former president, probably his most effective line, his question of, look, if these are all the things you want to do, then why haven't you done them yet, was probably the most effective one. Although I would add that most American people, and probably most of the people who are undecided voters, probably didn't even know who the vice president was until she started running and what the job entails. So there's that factor. I think also the difference in that, though, and I'll go with we can get into the details of the debate and whether we're keeping our pets safe. But the factor is, and as I've said on previous ones, if you simply watch a debate on mute, and what do you see? You certainly saw President Trump trying to create his persona and at times a face that looked much like a scowl or a Darth Vader's mask, trying to imitate that, while Harris, on the other hand, seemed almost incredulous at times. And I think for Harris, the missed opportunity that, while she did get the former president to take the bait quite a few times, she did not, I think, get through to the American people on where the exact details on some of these policies would be, particularly in areas where she's had a U-turn or flip-flop from past position.
So there were the whole thing was very sparse on facts from both sides, and the entire campaigns for both sides have been pretty sparse on the facts. And it seems like a campaign is that from both sides that's sort of being conducted by give them the idea and sure as hell don't give them the details.
Mm-hmm.
Long as we can keep them focused on the concept, we don't ever have to tell them how we're going to get there because they really don't care. Am I
That's
saying
exactly what
something
the
that's
former
going to appeal
president.
to them? Huh?
It's exactly what the former president said on healthcare. You know, what's your plan on healthcare? And Trump's reply was it's the concept of a plan is what we have. So it's exactly those words. And look, as a Chicagoan now, I'm used to hearing that from the Bears management when it comes to quarterbacking, but not necessarily the president of the United States. So look. Who has more of a plan? Yes, there's that, but I think neither one really could do it. You know, look, President Trump wants to show that he's a how much things were better when he was around. But again, while voters acknowledge that, those questions of temperament and personality can continue to come up, and those were not assuaged at all during that debate.
I suggested early when we started the FarrCast today that perhaps the biggest thing that came out of the night was an endorsement from Taylor Swift of Kamala Harris. Really, to me, if anything's going to move the needle, and her hundreds of millions of Twitter followers and fans, this woman is a force in the universe somehow. Tell me, do you agree with that? Can they move? Can she move the numbers? Can she get folks out voting?
I think she can, although I discount certainly a lot of the celebrity endorsements because I think in many ways they pull voters in some ways that already were thinking this way. But look, anything is going to help in a turnout battle. So all of these celebrities that the Harris campaign can get, I think that will be helpful for them. I don't foresee it backfiring because I think among those where it does backfire, they're already voting for the other side to begin with. So I think you note that. I think the Swifties, you mess with them at your own risk. But I think even more of note to me, where if we talk about this, where it truly is a 47-47 type election, and you're worried about every 1,000 or so voters in key states, the fact that we're seeing polling now saying that about a fifth to a 5 to 15%, so 15 to 20% of Republican voters felt after that debate that Donald Trump isn't as sharp as he once was. So if that's the area where you start to see that, and look, you've seen, I'm hardly going to imagine that Alberto Gonzalez, for example, really moves many votes. But when you have the Attorney General in the George W. Bush administration now endorsing Harris alongside, again, the Cheneys and others, are you starting to create a quiet permission, as it were, for some Republicans to not vote for Trump come November?
What does that mean, that former Vice President Cheney and Congresswoman Cheney, former Congresswoman Cheney, have endorsed Kamala Harris? What does that mean? What does that mean to the Republican Party that they would do that? Because the Republican Party has always sort of had a ring fence loyalty. Barbara Bush she was the champion of it. Mrs. Bush was amazing. I mean, if you could do whatever you wanted as long as you voted Republican, according to the First Lady.
Yeah, that's the end of the old party first commandment. Thou shalt not speak ill of another Republican, as Reagan said it. But in the Cheneys case, and we saw this through the January 6th investigations, the Cheneys said that despite policy differences, the Harris election would not be a threat to the Republic. That's the simple way they see it. And I think the January 6th area, and if we want to look at missed opportunities for Harris, I think that was one area during the debate where a doorway was left open for her on that issue, because Trump throughout the debate spoke of himself as, the strong man, the commander in chief, the one in charge, the boss of all bosses. But then when it came to the topic of January 6th, he was more than happy to say that Nancy Pelosi and Mayor Bowser of Washington, D.C. were in charge that day. So again, that juxtaposition there, and January 6th being an issue where I again think that more conservatives than we see in the polling still have qualms about what happened that day.
So, Dan, as we just back off by a good distance, take a deep breath and say, all right, We watched the debate. We're in the middle of this campaign, towards the end of it, really. Thank God, by the way, huh, ladies and gentlemen? Thank God we're at the end of this thing. Only have another 60 days to go or so. Maybe not even. Dan, what's your take? Where do things stand now? Where do things stand now with what you expect as an outcome in November?
What I see now is my question is, and this is where my unknowns are, known unknowns, is what momentum do we continue to see in the polling out of this debate? And if there is a third debate, or as we now see on Truth Social, a refusal to debate, how does that magnify the momentum here? And as you said, things like the Swift endorsement, can Harris do things like that? But long story short, I still see this coming down to the wire, and we're going to be up late waiting to hear from Pennsylvania, Arizona, and those places, if not late into the night, later into that week.
Will we know in December? Will we know in December who the president of the United States is?
I believe we will.
We will. Okay. All right. Well, I'll go with that. Dan Mahaffee, thank you so much. This has been gotten a lot of insight. We're going to talk about some of the economics too, about tariffs, what they mean, what's happening with rates, and the importance of the Federal Reserve. When we come back, one of my favorite guests of all time, Mark Hamrick. He is the guy, the chief strategist, economist at Bankrate.com, a great friend of mine for years, going back Associated Press days. This guy gets it. Also a past president of National Press Club. How about that, folks? When we come back on the FarrCast, please stay with us.
Michael Farr and the FarrCast are proud to support Heroes, Inc. Heroes supports the spouses and children of law enforcement officers and firefighters who gave their lives in the line of duty to the greater Washington, D.C. community. Their singular goal is to honor the supreme sacrifice made by these individuals by caring for their families. Heroes' work begins within 24 hours of the tragic loss and continues indefinitely. We invite you to learn more about Heroes' mission at heroes.org. We hope that you will consider supporting Heroes as they endeavor to honor those who protect us. That's heroes.org. Heroes, here for you, here for good. And now, back to the FarrCast and your host, Michael Farr. We appreciate you listening into the FarrCast this week. And now to introduce this week's special guest, here's your host, Michael Farr.
Welcome back to the FarrCast. Joining us now, as promised, folks, my friend Mark Hamrick from Bankrate.com. He's senior economist at Bankrate. He's also the Washington bureau chief at Bankrate. Think about that, to be the Washington bureau chief at Bankrate, to try and have to interpret Washington for Wall Street and the world. That's why he's on the FarrCast, following Wall Street, Washington, and the world. Mark, welcome back to the FarrCast.
Always a pleasure to be in your company, Michael, over these many years. What a pleasure, what an honor.
Over these many years, we've had a lot of fun, and when you're on, I learn things, and I know our audience does too. Mark, we've been talking a lot about politics today. The Fed is in their quiet period. We hear from them next week. What's your view, and what are you hearing on the state of the economy? And ladies and gentlemen, Bankrate does lots of surveys, not only of professionals. I'm a part of Bankrate's surveys on markets and economic data, have been for years. Thank you, Mark. But also lots of consumers, and they have a lot of consumer data. So what are you seeing in the economy, and what do you expect from the Fed?
Yeah, thank you, Michael. And I appreciate the shout out regarding our survey work, because that's what I do when I'm not having the opportunity to talk to you and others. And, it's a lot of preparation before we take to the airwaves, so to speak. And then that's really the core of the preparation that we do. And it's consumer surveys, as you said, it's experts, professional investors like yourselves, and separately economists. In terms of where we are with the economy, I think, if you think about the fact that it's football season, it feels like we've gone into overtime here and we've avoided a recession, despite the predictions that would have happened before halftime. And I think that, first of all, is most remarkable. And the forecast for Q3 with GDP are above the long-term trend. So despite more high interest rates set by the Federal Reserve, despite a consumer who is mightily challenged, here we are, and real consumer spending is expected to be perhaps 3% or better in the current quarter, spending adjusted for inflation. Having said that, I resist the description of the consumer because we're talking about, you know, tens of millions of consumers in the United States, hundreds of millions of consumers. And so at this time of huge disparity in wealth and incomes, even when household net worth continues to set new records, we have to think about the wide array of capabilities and resources that consumers have, and a good number of them are struggling. So we just published sort of our holiday outlook for survey for consumers, and a third said they're going to spend less for the holidays this season. 1 in 4 said yes, they'll spend more, and about 43% said the same. So I would say that's probably close to typical in the sense of some caution out there. But as you know, Michael, in following these publicly traded companies, there's just so much commentary, save for the occasional banking CEO that speaks to the consumer, struggling. I just saw Kroger's CEO today saying we see, more people trading store brands for or name brands for store brands, and you hear about McDonald's needs to go to the value meal, and we're seeing more and more of that. So I think the Fed is cautious, but also thinks that the performance of the U.S. economy has been remarkably stable, but obviously does not want to see the nation's unemployment rate and unemployment in general rise.
Yeah. So, Mark, we're also seeing, speaking of the consumer, we're also seeing that the revolving credit for the consumer is rising. Credit cards balances, therefore, are rising. Consumers, the savings rate has been dropping. It seems like the consumers are borrowing more. The consumers late on payments, that number's also on the rise. Auto loans, etc., also on the rise. How do those come out in your survey? Because you get consumers saying, no, we're going to spend more, but at some point they've got to have more, and they run out of credit card bill room, don't they?
For sure. We don't, you tell me, but we don't really hear the financial industry speaking about the need to set aside a significant levels of capital in anticipation of consumers unable to pay their bills. But obviously, we do see those delinquency figures rising. And I think that's part of the broader, dare I say, normalization of the economy after the violent disruptions and distortions that were caused by the pandemic that we're only sort of now putting behind us. And we're thinking about it's going to be the 5-year anniversary sooner rather than later. Quite remarkable, a half decade. So yeah, there's going to be a component of the population which does continue to rely heavily on credit, but to their detriment, because the latest Bankrate Weekly survey with respect to credit cards finds that for the best qualified individuals getting new offers, that's at just about 20.75% and is little changed. That will go down.
20.75%, and that's if you've got good credit.
Exactly.
Boy.
I don't know what the mob charges, but
I think it's less. I think it's less because I believe the mob has said that 20% is usury and immoral. That's even offensive to the mob. So okay. Let's.
But you can lose an arm and a leg literally in that instance. But that's another.
Yeah. Okay, we just got banned off about 3 of our broadcasting services, I think. Hey, Vinny, make the call. Okay. So, Mark, we're looking then at mortgage rates. The real estate market is hugely important. New home construction, renovations, the DIY big box retailers, all of this area of the economy, hugely important to driving economic growth. Mortgage applications had been lower. Rates are now coming back down. I think we're getting closer to 6%. Can Bankrate tell us where we see a 30-year right now?
Well, with respect to the 30-year fixed rate mortgage, which, as you know, and people who have purchased homes know, and probably those aspiring to buy them know, is the workhorse of the home finance industry in the United States. And the recent survey that we did in recent days finds that average at 6.31%. This is a survey of large lenders. And that's the lowest since February of last year, much the same as the other key mortgage average that people watch.
So the rate is what?
There.
What was it?
6.31.
6.31. Now, when you see a 6.31 headline come through like that, there are folks who are getting mortgages at even lower rates, special deals at other banks. You can shop around, right? I mean, bank rate says to shop around, don't you?
Yeah, for sure. I mean, that's been our call to action since we were founded in 1976, before we knew the internet was going to be a thing. And now you can, find rates that are specific to your zip code, specific to your credit score, et cetera. Some people are getting rates that are in the high fives and high-fiving one another when they get that. So that, is helpful.
So you can get, there are mortgage rates out there, 30-year mortgages below 6%. Now,
Yes.
ladies and gentlemen, if you happen to take a mortgage, and it might have been 6 months ago when rates were over 7, if you got one of those 7% mortgages, you can look at refinancing. You can look at refinancing 6 months later and take a look around and do a little bit of research and see how much you can lower your payment. There's some cost to doing it, and you really do need to do the math on it. But it sounds from our friend Mr. Hamrick that you might have saved a little money here on the FarrCast if you're willing to do a little bit of research and you have a relatively new mortgage. There's not a huge amount of volume, though, is there, Mark, in the mortgage applications? I mean, it's just not somehow this real estate market with a lack of supply, or people who don't want to give up their old 3 and 4% mortgages don't want to sell. And so there's not a big supply. Is that market, are you seeing signs that the real estate market's picking up, or mortgage originations are increasing?
I think we are, but as you indicated, it's only going to be marginal. But I do think that, there's not a very tight relationship or correlation between mortgage rates and what the Federal Reserve does. That's more, as you know, Michael, for the purpose of the audience, related to what the 10-year Treasury yield is.
Yes.
And I do think, though, that most people aren't walking around with that knowledge unless they're in the industry. I think that as the Fed cuts rates, that is going to be seen by many people as permission to wade in and start thinking about, oh, well, rates are coming down. And of course, we just talked about the fact that rates have been coming down. I think some people are going to say we should perhaps think more seriously about that. And if we have a news cycle here through the end of the year where we get, 3 more rate cuts, then that's only going to accelerate. So that could sort of mitigate the so-called lock-in effect that you referred to there, Michael, where people who are, like me, have been in a house for a long time with a low mortgage, and people might be thinking, well, we don't want to move until mortgage rates go below 4 or 5%, and our bank rate surveys have indicated that's a substantial part of the marketplace, that they just are not ready to go yet.
So you're the senior economic analyst for bank rate. Give us your economic outlook then, Mark, coming into the end of the year, and what do you expect for 2025? Are we going to see a return of inflation? Do you think we have a recession? Do we get to 3% GDP growth in 2025? What are you seeing?
We'll be surveying economists on that question again here soon, and I'll be reaching out to you for our professional investor outlook as well. But in terms of the outlook, I think that, first of all, it'll be very helpful that the Fed begins removing restriction from the economy, which has been so significant over these past several years. And as we know, every time we get a lower consumer price index, the Fed just tightened again because the real rate becomes more restrictive. So they really need to get to that business, and that's expected. And then, Michael, let's think about the fact that we've had exogenous or black swan or unusual events responsible for the last 2 recessions in the United States, neither of which were really seen coming. That was the great financial crisis, the housing bust that turned into something that was very horrific, taking under some of the mightiest financial institutions in the country, as well as an automaker. And then, of course, the COVID situation. So we didn't see those coming. I think at this point, we'd almost welcome a recession that we would never welcome generally if it were caused by the Fed, but the Fed doesn't want to cause a recession. So I think we just sort of stick with the game plan on the outlook and think that maybe the unemployment rate goes up, maybe another 0.3%. And then if and when that happens, then the central bank becomes more attentive to the job market part of its dual mandate, which is split between inflation and employment, and they'll be riding to the rescue again. But I don't think that it's reasonable to expect that benchmark interest rates or interest rates in general get anywhere near where they were before, in the sense of we spent so many years at record low levels. I think we should be prepared for higher benchmark rates and higher rates than what we saw during those remarkable times.
So we had, high rates, short-term rates from the Fed. We've seen things slow. We've seen inflation come down, and the Fed is changing course. I think it's the most important thing that's happening right now economically. The Fed is changing course. They are stopping the tightening. They're going to loosen a little, but basically it's an easing off of the brakes. It's not hitting the gas is where we are really. They're no longer standing on the brakes. We might be coasting, if you can picture the car coasting, but not hitting the gas yet. This is a little trickle, make sure the engine doesn't stall. That's what they want. Well, we're gonna see. And bank rate is so helpful in that they continue to provide us with data, and they continue to see what's going on with the professional expectations. And then with the real rates that they're out there surveying, you can get a real capture and say, this is what people have to pay today for a mortgage. That's very helpful to me as I try and figure out my economic outlook about what the consumer can and cannot afford. And it does put extra brakes on. So with those mortgage rates coming down, that's a very good sign. I think that's a sign that things are indeed loosening up. Mark, we thank you so much for being with us again. We always learn so much, and we hope you'll come back.
I would love it and always will. And thanks so much for having me, my friend.
That's it for another FarrCast, ladies and gentlemen, as we cover Wall Street, Washington, and the world. We've gotten through the debates. We've heard from Polcari. We heard from Hamrick. I'm grateful to all of our guests. For Harry Jennings, our producer, everybody at Hightower, and Farr Miller in Washington, thank you so much for listening. Please share us on social media. We're going to take next week off, but I'll be back soon as I can and get off the road for another FarrCast. I love being with you. Thanks for being with me. I'm Michael Farr.
Thanks for being with us this week on the FarrCast, and thanks to our guests, Kenny Polcari, Dan Mahaffee, and special guest from Bankrate.com, Mark Hamrick. That's a wrap for this episode, and that's a wrap for this season. We began this podcast in 2017, not knowing that over 350 episodes later, we'd still be coming to you with insights from Wall Street, Washington, and the world every week. We began recording at Tony Kornheiser's Chatter Studios and have been through an office studio, recording over the phone, and now in the post-pandemic world, a virtual studio, sometimes with guests, producers, and hosts being on 3 different continents. I'm proud of the quality of the show that we brought to you, and most of all, we hope you enjoy the show as much as we enjoy making it for you. We want to give our guests a platform where they can go beyond a soundbite or a quick summary and have a conversation with room to explore the ideas and currents that shape the world around us. And yes, we do have fun. I hope that we provide you with information that helps your understanding of the economy and markets, and that you enjoy and maybe crack a smile every once in a while listening. The FarrCast is produced by Michael Farr and Harry Jennings and comes to you weekly for free on all major podcast platforms, including Spotify, TuneIn, and Apple Podcasts. Please share us with friends and colleagues. We've grown our listenership by word of mouth, and we hope to reach even more in coming seasons. Please be aware that anytime we or any of our guests mention a specific company, sector, or refer to performance in relation to an earnings report, news headline, or economic trend, it's not a recommendation to buy or sell. Review the risks and rewards of any investment with your financial advisor for what specific investment and general strategy is appropriate for you before you make any investment decision. As always, if we can be of assistance at Farr Miller in Washington, please reach out to me at hjennings@farrmiller.com. We are here to help, and I'm happy to arrange for any of our listeners an appointment with one of our financial professionals to review your portfolio, your needs, and your goals. We love reading all of your notes, and we try to reply to as many as we can. You can reach us at hjennings@farrmiller.com. Let us know any questions you have about past episodes or questions you'd like us to address in the upcoming season. We do have a scheduled week off next week, but we'll be back with you in 2 weeks to kick off Season 8. Until then, take care, stay safe, and stay healthy. Thanks for listening to the FarrCast. Wall Street, Washington, and the world. Farr, Miller & Washington is a group comprised of investment professionals registered with Hightower Advisors, LLC, and a SEC-registered investment advisor. Some investment professionals may also be registered with Hightower Securities, LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors, LLC. Securities are offered through Hightower Securities, LLC. All information referenced herein is from sources believed to be reliable. Farr, Miller & Washington and Hightower Advisors, LLC have not independently verified the accuracy or completeness of the information contained in this podcast. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates make no representations or warranties, expressed or implied, as to the accuracy or completeness of the information or for statements or errors or omissions or results obtained from the use of this information. Farr, Miller & Washington and Hightower Advisors, LLC and any of its affiliates assume no liability for any action made or taken in reliance on or relating in any way to the information. This podcast and the materials contained herein were created for informational purposes only. The opinions expressed are solely those of the authors and do not represent those of Hightower Advisors, LLC or any of its affiliates. Farr, Miller & Washington and Hightower Advisors, LLC or any of its affiliates do not provide tax or legal advice. This material was not intended or written to be used or presented in any way to any entity as tax or legal advice. Clients are urged to consult their tax and or legal advisors for related questions.